Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be sharing with you my top 10 stock market tips. I'll also give you my views on the All Ordinaries Index and this week's stocks of interest that you've asked me to look at. Thanks for joining us today. I'm sure you'll gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. Now remember, if you have any topics that you want me to cover, please comment below. Also subscribe to our channel so you keep up to date. Go on, press that little red button. It's really easy. Now before we get into the report, click one more time on that like button. Also remember to get on the Wealth Within live stream. This is our new stock market show that we present live on YouTube every Tuesday, 7 to 8 p.m. Australian Eastern Time. Stick it in your diary, or better still, subscribe to our channel and you'll know when we're live and online. So let's get into this week's report. I guess if you're watching this video, you're interested in the stock market. The challenge most people have is that there are many myths and misconceptions communicated about the stock market, not just by those in the financial services industry, but by those in wealth creation. So why do they do that? Well, quite simply, they either do not want you to be independent as you create your wealth, or they simply want to prey off your desire to create wealth. For the most part, the industry is profiting from the uneducated, and in doing so, lining their pockets and not yours. So how do they do that? Well, they just keep pushing the view that investing in the stock market is complicated and mysterious. Worse, they say it's best left to the so-called experts who are supposed to know what they're doing. Yes, this fallacy is perpetuated by the financial industry as they stand to gain from your fear, anxiety, and dare I say it, ignorance. After all, we do not know what we do not know. And we also tend to trust people who are perceived as authorities. So how does someone who is inexperienced, achieving very mediocre returns, or possibly losing money, work out from the overwhelming load of information out there what they should be doing? Well, here's where my top 10 tips will help you. Let me say right up front that getting better returns on the stock market is very easy. All you need to do is dispel the many myths that are holding you back. Now before I get into my 10 tips, let me say that the majority of people do not get started because they think they need to be good at math or have a technical mind, amongst many other things. The reality is that you don't. Now my first tip is don't dollar cost average. This is a concept that has dominated the financial services industry for decades. According to industry experts, dollar cost averaging can reduce your risk of investing in volatile markets. What they don't tell you is that volatility is what makes your money. The industry also says that it helps you to avoid the so-called pitfalls associated with trying to time your entry into the market, as they believe it is not possible. Now, based on that statement, it means that what I do all of the time as a trader is the impossible. But that's another story. The concept of dollar cost averaging involves depositing a fixed dollar amount into an investment at regular intervals over a period of time. This started back in the old insurance days where you signed up to pay into a policy every month, and hopefully in 30 years you were wealthy and retiring in the Bahamas. Well, when I was 19, I signed up for one of those policies, believing it was the way to guarantee I would be rich. Well, if you read my book, Accelerate Your Wealth, you will find out that this investing technique did not really work out for me, nor did it work for most people. The thing is that they invest your money every month, regardless of whether the market is moving up or down, so as to average the price at which you purchase the asset. Yes, I hear you say, but if these people are experts on investing, why would they continue to buy when the market is falling? Now, you'd be right in thinking this is not really a smart idea. In fact, it is very unwise and unexpert-like. The real emphasis with dollar cost averaging is the inability of you, the investor, to time the market. Consequently, they encourage you to invest smaller amounts over longer periods of time to take advantage of the fluctuations in the market. Sounds awesome, as you can build and compound your money. Well, the reality I found is that it did not happen, and I was not alone in this. In my opinion, the dollar cost averaging strategy is flawed. Why? Because not only has the investor lost the opportunity to invest their funds in assets that are rising in value, but they are taking higher risks investing in assets that are potentially falling in value with no guarantee of making a profit on them. Now, I'm sure you'll agree that this is ludicrous in anyone's book. So what's my second tip? Well, this is that cheap does not mean you get a bargain. Many newcomers to the stock market mistakenly believe that buying cheap is the best method for achieving higher returns. But what is cheap? Well, if you've been watching my videos, and indeed watching our live stock market show, you will see quite regularly that people ask me about perceived cheap stocks. They ask questions like, should I buy? Where is it going? And should I hold onto it, to name a few. Some of these stocks are less than 1 cent, some are just a few dollars. Let me say up front that how many shares you own in a company, nor its share price, gives you any indication whatsoever as to how much money you will make. This is the number one biggest myth that I see perpetuated, and it constantly costs people their capital and decimates their returns. Buying a stock because the share is trading at a lower price compared with others is not a valid method of comparison. The buying something because you feel it's cheap belief not only costs you money, it hinders your ability to generate profits, because for the most part you're investing your faith in speculative stocks. In other words, you are speculating that a perceived cheap stock will perform better than a solid blue chip stock, and you simply cannot make that assumption ever. In my experience, anyone buying or holding onto a stock that is perceived to be cheap is gambling. Worse is if they own one that is falling in value and they continue to hold it in the hope of a recovery at some stage. Unfortunately, buying cheap is very much fraught with danger and generally ends in a costly mistake. Indeed, when investors buy cheap stocks trying to get a good buy, they end up usually saying goodbye to their money. Therefore, your aim should always be to buy quality stocks, not quantity, because this is where you'll get the greatest, easiest and safer gains. Now let's get on to tip number 3, and this is buy and hold really is not the answer to get good returns. Probably the most perpetuated myth in the financial services industry is that you should buy and hold for the long term. Now the reason we hear these words is either because the financial industry cannot time the market, or they want to do less and deliver a poor to average return rather than a good return that just takes a little bit more effort. In simple terms, funds unlike you are simply too large to maneuver into and out of the market with any speed. But you're not a fund, and so you do not have to do what they do. Consequently, the industry cautions us through advertising slogans about the perils of attempting to time the market. But if you accept that time in the market is more important than timing the market, then you are probably subjecting yourself to one of the greatest downfalls of anyone wanting to beat the market average. Now, unfortunately, the majority of investors who adopt this approach achieve mediocre returns at best, simply because all the gains they achieve in a bullish market are decimated when the bears take control. What this does is give you more stress and uncertainty. In my experience, taking a more active approach allows you to participate when the market is bullish and sit on the sidelines when the market is moving sideways or down. In doing this, you have less losses, you make more money, and you have less stress. Now that has to be a winning combination. Now let's look at tip number 4, and that is to use leveraging wisely. Unfortunately, the poor understanding and use of leverage leads the majority to trade more on emotion rather than logic. Most using leverage are chasing the market in the hope of attaining riches. Normally this is through ignorance and being sold a dream by some provider of a leveraged product or service. What occurs is that overconfidence abounds, particularly when trading highly leveraged markets such as Forex or contracts for difference, as people often mistakenly believe that they can handle the fluctuating extremes of these markets simply because they watched a video or two or they did a free online course with the provider. The sad reality is that for most, trading highly leveraged instruments is like giving the keys of a Ferrari to a 10-year-old and telling them to go for a drive. The real truth of the matter is that unless you've proven to yourself that you can profitably trade stocks directly, you should never consider trading leverage markets, as your chance of success is less than a few percent. Once you have trading experience, you may want to trade leverage markets. If this is so, then my advice is that you never invest all of your available capital and never leverage beyond 50% of your total portfolio. Tip number 5, well, this is another big one, and that is don't follow the herd. I constantly see investors react to market conditions, stampede up the mountain when the market is rising and crashing down just as fast when the market is falling. Unfortunately, this mentality is proliferated by the daily market reviews and sentiment expressed in the media. But what is it that drives us to follow the herd, particularly when it comes to the stock market? Well, it's common for investors to follow the herd to avoid the feeling of remorse in the event that their decision proves to be incorrect. Now, I often hear statements like, "Hey, my friend's doing it and I thought I'd give it a go myself." What occurs is that herding reduces the time you require to properly analyse an investment decision. The thinking is that because if everyone else is buying, then someone must have been smart enough to have already done the required analysis, which is not necessarily true. The reality is that many investors would rather purchase a stock that others are also buying in order to seek comfort in the knowledge that they are not alone in their decision making. It also enables investors to rationalise a stock that starts to go down. Since everyone else thought so highly of it, it makes sense that they did too. Now, in my experience, it's wise to take a contrarian view to investing, which is supported by Warren Buffett, who once said it is better to be fearful when others are greedy and greedy when others are fearful. It is also my experience that investors generally buy and sell too late because they follow that herd. This is because they hear that XYZ stock rose 50% last month, and so they jump on board hoping for it to do much the same this month. Then as the stock falls away, they move into a state of uncertainty of, do I hold or do I sell? That is until it falls enough that they either panic and sell or justify holding, saying it will come back to what they paid. But will it? And when will it do it? As you can guess, this is not wise investing. Remember, the best time to invest is before the stock goes up in price, not after it. Hence why you need to be contrarian. That is it for tip number 5. I'll cover tips 6 to 10 in my next market report video. For now, let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Wasn't last week an interesting week on our market? We saw it go down earlier in the week like I was been expecting over the last few weeks. I did think our market would fall away. It just took a little while longer than I thought to start falling away. As I said, I thought 2-3 weeks ago we should have started to see it fall down into a low to really slow down this upward trend. Markets don't generally rise at this fast for this long, or our market doesn't. But last week was quite interesting. The real interesting part about it was it came back later in the week to close a little bit higher. So let's go and look at the chart right now, and I can show you what I'm talking about. If you see here on the chart here, we see the All Ordinaries Index 10 weeks up and nearly 16%. That's a massive move on our marketplace in both time and price. But we can see where my pointer is where it closed for last week. Now the high was the Thursday prior, or the Thursday on the week prior. So we had a few days down earlier last week where it opened at 6287. But it closed at 6265. It was like 22 points between the open and close. But if you look at the range, it was 90-point range. So that's interesting. And that would suggest to me that the market will move up from this week and it'll start moving up, and it'll go through that 6350 points, and the market is quite strong, meaning there's not a lot of sellers in the market wanting to push it down. I'm not saying our market won't go down this week, and I would actually prefer it to go down this week. And as you can see there, I've got a target there of 6132, because I don't think our market's fallen hard enough yet. And if I put my fancy little tool on it, you can see there it fell 2.13% between that Thursday, and it really was 3 or 4 trading days. It really just fell and came back late last week to close higher. I just don't think it's fallen enough yet, and I'd prefer it to fall down to this 6132 over this week, maybe the next 2 weeks, and readjust the momentum for them to come back. That's it. I still think our market's more medium to longer term bullish. I still think there's a lot of legs in this. I think our market will move through those recent highs back in August, so the high from August, and then go and really start to attack that old all-time high back from 2007. I think our market will beat that by the end of this year. But it is quite interesting when you look at the news around, and you don't have to go onto YouTube and type in stock market or look at the news, and there's a lot of concerns, especially in the US, and I've just seen a few more I suppose clickbait titles on YouTube, stock market crash, just to get people to watch it. I don't think our market's definitely not going to crash. It's not possible, or the Australian market, it's not possible for it to crash. I think we are more bullish, and I don't even think the US market's going to crash. But if you want to look at my US report, go to my US video and you'll see what I think of the Dow Jones. But I just don't think, when you've got people saying the stock market's going to crash, then to me it tells me it's not going to crash, and it is quite interesting. But let's go and look at this week's stocks. I'll just go and bring up the workbook for this week's stocks, and I've got a couple of questions. Now remember, if you want to get your questions answered and everything, you can do that by just posting below here, or get on live with us on Tuesday night, 7 to 8 p.m. every Tuesday night. I'm live online with Janine Cox, our senior analyst and trader, so getting online live, asking all your questions. But this week we've had a couple of interesting things here in terms of questions. The first one I've got was from an Andrew Canobra, and Andrew says, I have a question about small caps and their risks. A great question, small caps and their risk. I'm invested in Orinoco Gold OGX, which is sitting at 0.4 of a cent at the moment. I want to stick with it, but worried it might lose. What do you think? And as soon as I saw that, there's a couple of things. Small caps. This is not a small cap stock when you look at it. If you look at your screen here, you'll see obviously the monthly chart, very volatile here. You can see that it's trading at its all-time lowest prices around here, around that 4 cents mark. A bearish stock, and I can't see why that this person would have bought this stock at all. There's no reason to me why you would have bought it. But the thing is I find that people with the least amount of knowledge buy the most speculative stocks. This is a micro cap stock. It's not big enough to be a small cap stock. So that makes it even worse. But if we go over to the weekly chart, let me just open that up. If you look at this, you'll see it's just been in a downward trend. Now, I don't know when Andrew bought this, but a lot of people think that by buying small cap stocks that they're going to make more money, and the answer is absolutely. Your chances of making a lot more money by buying small caps is really, really, really low. Let's probably 0.1% chance of getting it right, because whilst you may be able to buy in, you may not be able to get out. And looking at this is a weekly chart, and you can see here, it's just going sideways all the way. And if I look here, you're talking about 40 million or 41 million shares at around 4 cents. There's not a lot of money. What you need to do is calculate it in terms of dollar terms. And I'll go down into a daily chart, and this is a really interesting thing. Look at this. This looks like a very, very, very speculative micro cap stock. When you see opens at the top and closes at the bottom, when you see a lot of these little dashes, that means that either it traded one trade for the whole day, or maybe, but also you might see that there's gaps here where it might not trade on some days. This is what you generally see on micro caps and very illiquid stocks. Now, people can look at this and say, okay, well, it's traded 5 million shares, 5.3 million shares. Wow, it's really liquid. It's not liquid. Multiply that by 0.5 of a cent, and you'll find that that's probably 0.5% on $5 million. Most people could actually do that. Do that themselves with the money they've got, but I think it's probably less than $10,000 for that day. I haven't quite worked it out, but it's not very, very much. If you find that your money will actually take up a lot of the traded stocks available that day, then you shouldn't be in this stock. And right now, I don't see any joy for Andrew about this stock. I'm not sure why Andrew's actually even in it, but that's his choice. He may have done some research on gold and gold mining and this particular stock. But generally what I find with people that get into these stocks, they've gone and visited chat forums and got tips from people. And that's the worst place you'll ever get tips from, and that's chat forums. You start to become a product of the herd, and then you start to get into stocks like this thinking you're going to make money, and it's not. It really is not the wisest place to go and get your education from, but stay out of these sorts of stocks. We'll look at a couple of bigger stocks in a second. We'll look at Rio and BHP, and you can see the huge difference in it. But always look at what the share price is and multiply it by the volume to see what's actually going, how much money's in there. And if you're taking up more than 1 or 2% of the daily trading, then you're way over what you need to be doing. Anybody could move this stock quite easily. I could move it quite easily myself with just my pocket money pretty much. So stay out of that. Another stock we want to look at here is called Prospect Resources. Now, this was another person called Christian. He says, I've invested. He's now a new Trading Mentor student. So thanks, welcome to Trading Mentor. And he posted this to me and he says, I've invested on PSC company for the long term, and he's got it exclamation mark. So I'm not sure exactly what that's about, but I'm thinking that he's turned what might have been a good trade into a long-term buy and hold. And I find people do that. They go, why did you buy that? Oh, it's long-term. But when they first bought it, it was a short-term speculative buy to try and make money, and they turn a bad decision into a long-term buy and hold, which is not smart. It's not good trading and it's not good investing. I want to ask you, do you reckon about this stock? Thank you. Now, he's possibly losing money, but looking at this, you can see again, a very, very speculative stock based on the monthly and the weekly. It probably came in here. I haven't even looked at it yet, but it probably did a backdoor listing around about 2012, because obviously this huge drop from 14 cents all the way down to, around to 1 cent. But looking at this weekly chart, there'd be no reason to own this stock either. I mean, I can't see any sort of joy about why you'd buy it, because look at that. It's now trading right down. If we look at this one, it's now trading at 1.7 cents, or 1.7 of a cent. And so it's a very illiquid stock. Again, 3.4 million shares traded at 1 cent. So just to get your calculator out and divide that in. But right now, Christian, I don't see any joy in this. I wouldn't own this stock at all myself. And I wouldn't have bought into it. It's too illiquid. If you're asking questions like this, it really does mean you don't have enough knowledge. And if you're trading companies like this, you're actually using what I would call the buy and pray method. Is you're better off buying bigger, better stocks if you've got less knowledge, because these are the stocks that even the professionals like me won't touch, because they are a lot more erratic and they're a lot more illiquid, and they're driven by emotions and that fear and greed a lot more. So they're much, much harder to pick. But again, have a look at this. This is your daily chart. Now look at this, how many days here we've got. 11th of January, 14th of January, that could have been a weekend, 15th, and look at it, it's just hardly doing anything. 200,000 shares, 17th of January. There's nothing much is going through this stock. Very illiquid, very not good investing in this sort of stock. So be careful when you're on the marketplace. Let's look at a couple of big ones. This one's AMP. I've got a question from Frank Migliore. Said, can you have a look at AMP? This one's been hard hit, and AMP fell to its all-time lowest price just recently. So that's exciting to me. Down to $2.12. Big company. This is a really big insurance company, obviously. And back in the 60s, 70s and 80s, everybody had AMP accounts, so it was pretty good. But it's just been slammed. But it's probably one you could put on your watch list. But it needs to hold up above this. But it starts breaking through that level at $2.43. I'd suggest to be a nice little better buy than those last two that you've got. You've got a lot more chance of making money out of this, and you'll actually get a dividend out of AMP. But we just need to make sure that it stopped falling in price. That's the major thing. We talk about trading on confirmation, not speculation. So confirm it's moving up. But right now, I think it'll move through that level in the next week or two, I'd say, and start moving up. So it could be a nice little buy there on the cards. Now, let's look at a couple of bigger stocks. And this is obviously the two that I looked at that were speculative or micro caps, both in the mining sector. Here's Rio. These are the stocks you should be looking at. Look at Rio, massive moves. It's down a little bit last week, so it might have 1 or 2 weeks. In the last month. If we look at last week, we saw that it had a big ranging week down here 2 weeks ago, range of $6.89. And people say to me, can't buy Rio because I can't afford Rio, but you can afford Rio. $90-something is not expensive or cheap. And this is what I tried to get through people on my live session last week is you don't judge a stock on its price. You judge it on what it's compared to. If this is worth $200 a share, then $90 a share is really cheap. Those other stocks that we looked at, OGX and PSC, they're 0.4 of a cent. That doesn't make it cheap. If it's only worth 0.1 of a cent, that makes it really expensive and harder to make money on. You'll make far more money out of a Rio than you will out of those other two stocks. You'll do it safer, and you'll have a hell of a lot less stress on your life, and you won't turn a good trade into a buy and hold strategy. But have a look at last week. It gapped down a little bit, traded right up and closed up near its high. So it'll be interesting to see if Rio does start to move up from here. If it does, it would be a nice buy because commodities are moving. Iron ore is moving, which is nice. With the Australian dollar moves the right direction, it might even help them a little bit more. But you can even see BHP's done exactly the same thing. It's not quite the same. BHP and Rio don't always work together. You can see BHP's had a couple of weeks down. Last week it closed on its low, but BHP may only have another week down and start to move up again, which means you'll be able to buy it. Instead of buying it around 38, you might be able to buy it around $36, that sort of area. Now, I'm just saying rough figures. Doesn't mean buy it at those levels, but I'm just saying right now BHP is having a little bit of a breather before it starts to move back up again. Nice time to look at these stocks. And the interesting thing, when the market is bullish, more people ask me questions. When it's a bit more bearish, people stop asking me questions, and you should be doing the other way. Should always be having that contrarian view. But that's it for me. If you do, as I said, get on to Wealth Within Live next on tomorrow night, Tuesday at 7 p.m, so between 7 and 8 p.m. So get on live, get your questions down, so post them below. Remember, like this video and please subscribe to the channel so that we'll let you know when our Wealth Within Live is on and keep you reminding you what you need to do. Good luck, take care, and good trading. Bye bye.